Hi there, welcome to Kneppy Invest, and welcome to another answer and reply video. Doing something a little bit different today, and I might continue this if it is successful. I have gone through all your comments and questions over the past week, and I have chosen 20 of them to answer. And the reason I've done this is because I'm getting way more questions and comments on my channel. That I suppose is a good thing. And I thought I have to be a little bit more choosy when it comes to this particular video. Now, what I've done is I've put all those questions onto a PowerPoint and then I've uploaded to Google Slides. So we'll just see how this goes. I don't think I'm tech savvy enough to transition between Google Slides and all the other stuff I want to look at. So just bear with me. Okay, so let's go to the first question. And this is from Sensei 6011. Thoughts on a company with the ticker code MNDY, listed on the Nasdaq, future potential, and how it has done since late October, early November 2022? Question mark. No idea this company or what this company is. Monday, Mandy, who knows? Monodelphis is actually MND. So this is going to be a completely new experience for me. Now, I love these sort of questions because it makes me explore companies I have never heard of before, particularly American-based companies. If it's like a mining exploring company, I couldn't care less at this point. But I'm looking forward to delving into this company with a ticker code MNDY. So let's do that right now. Okay, first of all, this company is actually called Monday.com. There you go. I was trying to be silly or stupid or smart by saying Monday or Mandy, but there you go, Monday.com. What does this company do? Monday. Is it a work thing? Is it a calendar thing? No idea. Now, the daily chart here looks pretty good over the past 2 years. This goes back to March 2023. So we're looking at about 2 years here. Share price has not quite doubled, but it looks like a pretty good chart. Where the share price pulls back, and we've seen that pullback recently and now it's starting to go up again, that could be a good buying opportunity. But that's a weekly or daily chart. If you have a look at the weekly chart, this company has only been listed since the middle of 2021. And it listed just before interest rates started rising. So that's why the share price rallied all the way up to 440. So probably this company is not yet profitable. And more than likely, most of their profit, if they ever have any or can produce any, is well into the future. So during that period when the interest rates that were rising, share price of this company dropped from 440 all the way down to 80. We saw a lot of companies do that, and now it's starting to rally again. Volume has remained pretty lofty over the last few years. Now, the next thing I want to look at is this is via TradingView, is just to have a look to see if the company is generating any revenue. And now, so this is a real company. They're selling something. What that is, I don't know. Now, a lot of times when I don't know anything about a company, what I might do, there it is, there's my Google Slides. What I might do is just Google the company, Monday.com. Well, obviously there's some sort of, not Mondi.com, I forgot the A. And there's actually is a company called Mondi. No, there's not. Monday.com. Oh, this tries to put it in, okay. Product solutions, resources, projects, tasks, marketing design, CRM, software, IT, operations, product. It looks like some sort of software, which makes sense, and something to do with work. Why not Friday.com? That'll make everyone a little bit more happy if it's called Friday.com. So yeah, something to do with work. It's going to do things you didn't think were possible. Anyway, I do sometimes like to have a look at a company's website, but in TradingView, they do have an About section right at the bottom. So Monday.com engages in the business of operating a cloud-based visual work operating system that consists of modular building blocks that can be easily used and assembled to create software applications and work management tools, and serves as a connective layer to integrate with various digital tools across an organization. Founded in 2012 and headquartered in Tel Aviv, Israel. There you go. And if we do have a look at the financials, that's quarterly. If you look at annual, beautiful growth in revenue. Although we could look at FinChat. Why not look at FinChat? Instead of looking at TradingView, let's have a look at FinChat. MNDY, why not? So I love to look at this sort of thing. Monday.com, never looked at this company before. Didn't even know a company existed. Markup is 13.23 billion. The company does have a PE ratio, so they have a profit, but the PE ratio is 620. So people are complaining about Medicus. Well, here you go, 620. But that can be misleading, particularly if the company's profit is fairly low, and there's potential, if the company's profit's really low, that profit could quadruple or go up sevenfold, tenfold over the next few years, which would mean the PE ratio is actually quite low. In fact, the forward-looking PE ratio is only 76.9. Revenue growth, 51% over the last 3 years. This company's only been listed for a few years. Earnings per share growth, negative 62.2%. And doesn't have return on equity. Gross margins, 89.5%. You would expect this company to have fairly high gross margins. Probably the most interesting thing about Monday.com would be their growth in revenue. And we can just see here, significant growth in revenue over the last 5 or 6 years. So even though this company's only been listed for a short period of time, when a company does list on the ASX, I'm pretty sure this is true for any company listed on the Nasdaq, New York Stock Exchange, they do provide the last few years of financial statements. So we do have more financial statements at our availability. Anyway, total revenue is growing at 67.5% over the last 6 years. So from 78 million to 906.6 million. So I can definitely understand why this company is quite popular, because that's significant growth in revenue. And this is always the first thing I look at. This is growing. It's a significant growth company. They are selling something that is liked by the market, and more companies are finding something to like in this company. Okay, so that's really the first thing I'd look at when it comes to Monday.com. Gross profit margins probably increasing. Yes, they are increasing. So they've been increasing up to 89.5%. And again, this company probably very low when it comes to profit. In fact, unprofitable by a large amount until this year. First profit, 21.7 million. And that's the reason why the P ratio is so high, because there's a possibility, if they really wanted it, they could increase their profit by 5-fold within a year, if they really wanted to. Anyway, so a growing company at this point in time. I'll probably have to delve a little bit more deeper into what they are selling, what sort of moat they do have, that sort of thing, how many competitors they have. But there are some things to like about Monday.com. And I do like, not necessarily the weekly chart, but the Monday chart does look good. I don't mind this daily chart. When do they release results? Now, another thing I like to go, in fact, you can do this in FinChat. Where is it? Investor Relations. You can have a look at the most recent quarterly. Looks like they released their quarterly in November. So we are talking about in a few, well, we can have a look at, well, nothing's popping up. There we go. Have a look at their slides. I'd love to have a look at this. Have a look at their financial statements, that sort of thing. So third quarter results. Talking about revenue in the quarter, $251 million of revenue in a quarter. In a quarter, they've grown that significantly over the last 5 years. A 33% year-on-year revenue growth. They've got a nice little chart there. Gross margins 90%. Free cash flow of 82 million, 33% of revenue. So if they are generating a lot of cash flow, or free cash flow, that would be really interesting as well. I know. So those are things I look at, and yeah, the chart looks pretty good as well. I might have to delve a little bit deeper into Monday.com. So thank you to Sensei. Okay, let's get to the next question. This next question comes from Scott II9RB, who asks, regarding being a better investor for the channel, you tested the 10-cent break theory for us on YouTube, Meeker Metals, and it's one of the best charts around now. I am trading Meeker Metals. I was seduced by the chart initially, but the second thing that really seduced me was the company's going to production, and I really like that. So we have a good-looking chart, company going to production. Doesn't necessarily always mean that it's going to be a good trade or a long-term hold. So let's have a peek at Meeker Metals chart. And the share price on Monday last week actually did fall below 10 cents. So that was actually a buying opportunity. I did not add to my position in Meeker Metals, but we didn't want to see the share price drop below 10 cents and stay below 10 cents. That would be fairly negative. So let's have a look at the chart for Meeker Metals now. Okay, so this is the daily chart for Meeker Metals. This is another brilliant looking chart. I do like this chart. There's a few things I like about this chart. A really nice little breakout in July last year. I had no idea this company existed back then. It took a while for me to, acknowledge this company existed. And there was a lot of time the share price was in an uptrend before that point. And this is an absolute truth when it comes to the stock market. There's going to be, or companies are discovered at different times by different investors and fund managers, because you're going to have the more risk-averse fund managers who might need 5-10 years of production from Meeker Metals before they even discover the company. In fact, some of those fund managers wouldn't even care about Meeker Metals ever because it's a mining company. And I'm thinking of Team Invest. You always see Team Invest on Ausbiz Core. The two most prominent people there are, what's his name, Howard Coleman and Mark Moreland. And I can almost guarantee you, whenever Howard Coleman is on the Ausbiz Call, I can almost guarantee you what is he going to say about every single company. He's a little bit too predictable for me. I do like Mark Moreland a little bit better because he has a little bit more flexibility when he does talk about companies. But Team Invest is way more conservative and they need a lot of history. So just imagine a company that has just become profitable, listed on the ASX maybe 2 years ago. I probably might discover that company now. Someone might have discovered that company when they IPO'd. And over the next few years, you could see more and more fund managers discover that company as it grows its revenue, as it increases its profits. And then in 5 to 10 years, Team Invest discovers that company because they're more risk averse. I'm more of a risk taker, and there's other investors out there who are more risk taking than I am. So along the Meeker Metals journey, everyone discovers this company at different times. I discovered this company when they did release some drilling results. I had a closer look at the company and I discovered there are some things I like about this company. The chart was one of them, and then also that they're going into production. Okay, so I took a position at 9.4 cents. It would have been on the 8th of January. So we're talking about exactly 1 month ago. And I'm just going to verify that, because I did buy on the day. In fact, I think I bought on open, if I remember correctly. I bought on open when they released the 8th of January. We have to go back 3 months. Yeah, the 8th of January announcement, released at 8:23, 23 meters at 26.73 grams per ton of gold, Bonanza Gold at the Murchison. That was a really impressive announcement. And the share price on that day did pop up a little bit. It was only up probably 11.63%. I bought some shares at 9.4, and I thought one of the reasons behind that was I expect the share price to get above 10 cents. I thought it would break out above 10 cents. So this is me being a little bit more risk-taking, because there is a risk that it won't break above 10 cents. But this was showing all the signs of the share price breaking above 10 cents. And it broke above 10 cents a few days later. In fact, on the 16th of January, it tested 10 cents a few times. Last Monday, it fell through 10 cents. In fact, it closed at 9.7 cents. And then the next day, it went back above 10 cents and has stayed above 10 cents since then. And then on Friday, share price closed at 11.5 cents. So that is the all-time, maybe not the all-time high, a long-time high, or long-term high at least. Yeah, we'll say an all-time high, and it closed at an all-time high. So the chart looks really good for Meeker Metals. I have no problems with this one. The other thing I like about this chart is the volume. You can see a little bit of an increase in volume. In fact, if you eliminate the last few months, you do see the first signs of volume increasing in July, and that is when the share price broke out. And then the volume increased even further in August, September, and that's another good sign. And then the volume increased even further in October, November. So a really good expansive increase in volume over the past few months. And in fact, the peak volume came on the day I bought. So I was one of those people. Volume has pulled back a little bit, but that's okay, because we saw that last time. Share price broke out, in July. But the last time the share price, we saw some really good volume coming in November. The volume dried out a little bit and then started to increase again in January of this year. So a really good chart for Meeker Metals. Okay, let's go back to your next question. Okay, this question comes from, or comment, more of a comment than a question, comes from Damien IF2KI. Cow, which is Kalgoorlie Gold Mining or something, is up 240%. Yet Nick Scali up 11% is stock of the day. No wonder I boycotted this bias channel. Thank you, Damien. I have to admit I am biased. I think every single person out there is biased. And the main reason why Nick Scali is, or was, the stock of the day over Kalgoorlie Gold is simply because Nick Scali is a real company. It's selling something, quality company. Kalgoorlie Gold up 240%. It could be down 100% on Monday, or it could be up another 20%. I don't know. It's a story stock. And in fact, with Kalgoorlie Gold, I'd say the chances of this company ever going to production is 5%. That's it, 5%. It's a story stock, and I am biased against story stocks. I'm definitely pro high quality companies, and that's a simple reason. Up 240%, I don't really care. It's a one-off. It could be a one-off. The other thing about Kalgoorlie's chart is if you bought when this company IPO'd, you are down more than 50%. So that's even after the rise of 240%. So that's a problem with mining exploring companies. You just don't know unless you have really a lot of expertise in geology and you can read all the company's drilling results. You just don't know, even when the share price is up 240%. And we have seen time and time again, a company share price will increase 240% in one day, and the share price will just crater after that. Now, the question, or the most important thing for Kalgoorlie Gold, is whether this little momentum, this little bit of enthusiasm in the company can be maintained over the next few weeks. If it's not, share price could fall over 200% in the next few, maybe not 200%, it could fall 50 to 60% over the next few weeks. And that is a problem in the story stock space. You need that enthusiasm to be maintained because it's a story. Just think of any story you have read in the past. If you lose your enthusiasm when it comes to the story, you're going to put the book down and not go back to it. That is true for companies as well who are story stocks. So when it comes to a story stock versus a high quality company like Nick Scali, who is up 11% in one day, that's pretty impressive. I'm always going to choose the high quality company like Nick Scali over the story stock. Okay, let's go to the next question, which is from Chris Murphy 3124. Would like to hear your opinions on Infratil. Okay, first of all, I'm just going to talk about the chart. Yeah, sometimes, or most of the times, what I do is usually talk about the company first, and then I go to the chart. For Infratil, I get a sense of what this company might become, or what this company already is, or how it's perceived by the market, just by looking at the weekly chart. This goes back to 2016. Now, if you go back to 2015-16, the liquidity in this company was quite shocking, and I can tell that just by the chart. In fact, you can go back further than that. Looks like the company listed in 2010, and there was no liquidity in this company at all, but the share price was going up at that point in time. So this is the weekly chart, and the main thing is, over this period of time, the share price has remained above the 200-week moving average, has remained generally above the 100-week moving average, which is the blue line. The only time it has gone below both those moving averages was during the COVID-19 financial panic. It has touched the 200-week or the 100-week moving average twice, other than the COVID-19. That was back in June 2022, and we saw an overall weakness in the market. And the other time is right now. So this is the second time the share price has hit the 100-week moving average. So this could be the buy the dip situation when it comes to Infratil. Now, this company is an infrastructure company. So one of the reasons I discovered this company, well, the main reason I discovered this company was they were getting into the data center space. And I thought that was a bullish move from the company. That's what the market thought as well. And that's why the share price ripped higher. But this is the chart of a high quality company. Now, if you look at the metrics, I would probably struggle to see some of those high quality characteristics. And the reason I say that is if you just have a look, we'll go to Infratil IFT. It's a New Zealand-based company, I believe. In fact, when you go to FinChat's Infratil page, you have to look or add or put, tap this plus sign there to go to the ASX listed IFT. Okay, so if you have a look at the overview of this company, P ratio is negative. Revenue growth is actually quite impressive over the last 3 and 5 years. So 65% growth last 3 years, 21% growth over the last 5 years. I think this is more like NextDC, that you have to believe that this company and they spend a lot of money on capital expenditure, that this company can keep on growing their infrastructure, the amount of money they've got in infrastructure, that sort of thing, and don't look at the profit. Because this company wouldn't have much profit, if any at all. And if you have a look at the financials by the way, this company owns, in the About section here, operates infrastructure businesses, primarily New Zealand, Australia, United States, Asia. Apart from data centers, I'd say probably to do with electricity, maybe some airports, I don't know. So they do mention here the company supplies electricity, commercial, industrial customers, develops, owns, and generates renewable energy, develops utility scale wind and solar generation throughout North America, develops wind, solar PV energy projects and storage solutions, outsource data center services, and so nothing to do with airports at this point. It develops and operates data centers, owns and manages a portfolio of real estate properties. So mostly to do with electricity generation and also data centers. They might have a little bit more than that because I'm seeing quite a bit of health here as well. Yeah, it looks like they own some health companies, or maybe that's real estate. Anyway, so if you do have a look at their financials, you won't see much, gross profits or gross profit margins, okay, but revenue's been increasing, which is good, but profit will be fairly low and sometimes negative. Yep. So you can't look at the profit of this company. It's just based off their assets. That's another way to look at it. Their assets and how profitable or how much cash flow those assets can produce in the future, which is why a lot of people became very interested in NextDC, because they're building their data center assets, not only all throughout Australia, but also all throughout the world, particularly going into Asia. And they always have to come back to the market for more capital because they need more and more money to build this data center or their data center assets throughout that area. So I'd say it's the same can be said for Infratil. And if we go back to the chart, the share price has pulled back. Is this an opportunity to buy some shares in Infratil? Just based off the weekly chart, could be the buy lip situation. So I actually haven't thought about that until right now. So sometimes your questions can make me think. Anyway, so I have not been a shareholder of this company, but it is on my watch list. And just based off this chart, I'm watching this a little bit more closely. Okay, so let's go back to the next question. This next question comes from Rick Tellier. Now that request, because he did ask whether I could do the same thing with Fortescue, and I was wondering what same sort of thing, and he sort of clarified that sort of question or thought in this particular question. That request, can we do that chart on Fortescue as you did with REA Group? You got a 28,500 increase over 20 years. Fortescue had a low of 2 cents. So let's do the same thing with Fortescue that I did with realestate.com or REA Group the other day. Unfortunately, in FinChat, I'm assuming this is what Rick Telling was asking for, the total return of Fortescue over the last 20 years and 1 month. There's nothing showing up on the chart here, but we do have a number down below. Total change is 20,338.2%, a CAGR of 30% per year. So that's fairly similar to what we saw, the CAGR return for REA Group. And this is something that can happen with mining companies, but they're really rare. These sort of returns over a 20-year period are extremely rare when it comes to mining companies, but they do happen. And I think you do have to pick and be lucky when choosing mining companies. So Twiggy Forrest was lucky that he was a shareholder of this company, and it can happen. You can become rich from owning mining companies, but you can also lose all your money by putting it all into mining exploring companies. I think it does happen a lot. And one of the things I used to do is I went to Hot Copper after a really bad mining announcement. So like a exploring oil company hitting a duster when the share price drops 90%. And a lot of posters would say, I lost all my money. That's it. So I'm never going back to the stock market. I've just lost all my money. I've also had an instance when a colleague of mine, when I was talking about not being a gambler, he said, oh, you're a gambler. You put your money in the stock market. I went, it's not gambling. It's completely different. And then the guy said to me, he had a friend who lost all his money on the stock market. And I can almost guarantee you that he put all his money into one company, maybe a mining exploring company, maybe a biotech company that was just a story stock. But more than likely, he put all his money into a story stock, and that story stock went bankrupt or whatever. And that is a problem. But with mining companies, you can make a lot of money if you choose the right thing or the right company. And one of the ways to choose the right company is just use technical analysis. Now, you can change this to share price. Actually, let's have a look at the chart. We'll do this via the chart. So this is the price. I don't know why when you click on total return for Fortescue, nothing shows up. It's broken. The line's not showing up, but you can actually see the total return down there. I think it's because for some reason the scale is really wonky. It's really wonky. I don't know why. I wonder if I change this to 5 years. Yeah, let's do that. Maybe this will work. 5 years. and then go back to 2005. No, it's still really wonky. Oh, I see why. Oh, we're going back. It's working. Can we go back to 2005? Oh, I think for some reason we have to go back slowly. Oh, it really hits a bit of a something wrong in about 2005. Anyway, so this shows you the total returns of Fortescue over the past, 20, no, almost 20 years. This goes back 19 years and 7 months. Still the same CAGR, 30.7% per year. I did trade Fortescue back in 2018, and I held it probably too short of a period. In fact, we can have a look at the chart. This was a really good trade, a beautiful trade. This happened just before the Vale mining disaster in Brazil. And that's one of the reasons why the share price took off. But there was a signal before that. I'll just show you how you could just trade mining companies. Now, at this point in time, Fortescue has just been going sideways for a while. And the main reason behind that is because the price of iron ore is not really doing anything right now. But if you go back to 2019, where is it? Here it is, 2019. In fact, we'll have a look at the daily chart. I wish I actually, I don't think I was using TradingView back in 2019, but I wish I just sort of put where I bought all my trades back then, because I didn't do many trades back then, but this was definitely one. So it would have been, 2019. You can see the share price started to move up in about January and February, a beautiful sort of breakout. And I actually played that breakout, and that Vale disaster, I'm pretty sure happened before that. Or after that, I'm sorry, Vale mining disaster. I definitely bought just before the mining disaster, January or 25th of January 2019. So it sort of coincides. 25th of January 2019 happened right there. So that actually mining disaster just happened before the breakout. Yeah, just after the breakout, not before the breakout. Yeah, I just remember buying just before and going, oh, this is lucky. I bought some shares. You can see Fortescue share price just went absolutely bananas after that that disaster. So this was a fortuitous event for me as I was trading this company, and then I sold way too quickly. So I bought at about $4. I think it went in $4.50 maybe, and I sold. I think I doubled my money, and then I just took profits. But there was no reason to sell Fortescue. In fact, I should have held all the way, into the 20s at least, and probably would have sold if I was doing it again sometime in 2021. Anyway, so that's Fortescue, and definitely you can trade these sort of companies. I would never own mining companies for the long term. The only one I might think about would be BHP, but for me, mining companies are price takers. Things can go wrong. Iron ore market, the iron ore price could collapse. It could happen. It happened in 2016. In fact, if you go back, have a look at chart of Fortescue, and there's been times when Fortescue was on the cusp of not making it. Share price of Fortescue in 2016, so January 2016 was the bottom of the iron ore cycle. Share price of Fortescue was $1.50. And at that point, there's no reason to be on this company for long term. Yeah, anyway. So that's my say on Fortescue and mining companies. Next question comes from Luca Brasi, 2130. I wonder if Luca Brasi is Italian or has Italian parents or heritage. I say 95% certain. Anyway, this is sort of the second question Luca Brasi has raised in regards to Jayride. I'm wondering if Luca Brasi is a shareholder of Jayride and is a little bit concerned about the future of this company, or maybe based off his questions, he doesn't like this company or someone in the management and he wants this company to go bankrupt. Please tell me about Jayride. Jayride, will it go bankrupt or does it have a chance? So I could see either thing here. Maybe, Luca Brasi, or maybe the CEO of Jayride stole his girlfriend or her girlfriend. Luca, I'm pretty sure Luca would be a male. I don't know, I could be wrong. Anyway, so let's have a look at Jayride. Not the sort of company I'm enticed about or I get nice, warm, fuzzy feelings about. And I just don't really know about their business model. And I think they have, I could be completely wrong, but I've always thought of this company as a company that transports people from their house to the airport, something like that. I could be completely wrong. So let's have a look at Jayride and answer this question. Will it go bankrupt or does it have a chance? First things I always do when I'm looking at a company is, well, the share price is the first thing I look at. 0.3 cents. I'm staying away from any company who has a share price of 0.3 cents. I wouldn't even look at this company, even if I had a look at the pennies for cent. I went, ooh, it's a pretty good quarter from this company. Share price of 0.3 cents. I don't care. This is more the plaything of pip traders. In fact, I wouldn't be surprised to see the share price fall to 0.1 cents. But if they do release something really positive, you could get a pretty good run in the share price. I would say this company has significant amount of shares on issue, or the share or the market cap is really low. So which one? It could be both, by the way. Let's have a look. The market cap is below $1 million. So the share price is really low, and only 238 million shares on issue. I did not expect a market cap of less than $1 million. So if this company produced a profit of $1 million in the next year, this company is, has a PE ratio of less than 1. But the question is, does it? 1 year return, 84.21%. So the share price has dropped a fair bit. Okay, let's have a look at the most recent Appendix 4C. Because the question is about whether this company might go bankrupt. So the first thing is, do they have any cash flow? Which I'll probably say no. By the way, I think I'm right just by looking at what they do. The global online travel marketplace for airport transfers. So even though I've never looked at this company in the past, I sort of knew this company was doing that sort of thing. And I just don't see a massive market. Well, maybe there's a market for it, but just a business model that could grow significantly. Anyway, where travelers compare and book rides around the world. Travelers can compare and book with 7,000. Oh, okay. So this is just sort of like a marketplace. So they actually don't do it physically themselves. I thought maybe they did it physically themselves. This is just a platform. So why not just use Uber or taxis? I don't know. Anyway, founded in 2012. C code is JAY. Let's see how successful they are right now. So receipts to customers, 1.781 million. Okay. So this company is generating a fair bit of receipts. And year to date is 3.4 million. So it's fairly consistent. Now, that's a small sample size, 2 quarters of history. But what's really interesting here, the company is or was operating cash flow positive by $29,000. Excuse me. $29,000 in the last quarter. Operating cash flow positive, $29,000 in the last quarter. Free cash flow positive also because they spent zero on capital expenditure. I wonder if they do capital expenditure, maybe a little bit on advertising and marketing. They don't spend a lot of money. So staff costs, administrative costs, advertising, marketing, and a little bit of interest. Now, because they do spend a little bit of money on interest, that means they have a little bit of debt. So that's the next thing I always look at. Repayment of borrowings, $37,000. So actually bringing their borrowings down. And what they've done with that cash flow, some more, but they've decided to repay their debt, which in my opinion is a smart thing to do. So I thought this was going to be an absolute disastrous pennies 4C, but not so. They are operating cash flow positive. Not a lot of cash on hand. It's actually dropped almost $200,000. And one of the reasons why it has dropped, even though their company is operating cash flow positive and they paid down a little bit of debt, is because of exchange rates. So effective movement of exchange rates on cash held are negative $190,000. So $487,000 of cash on hand. That's a little bit of concern because if they do start to burn a little bit more cash in the operations, they might have to go to the market for additional capital or increase their borrowings. So let's go to section 7. They have no financing facilities. It looks like they might have paid down their debt based off section 7. Cash on hand, they have enough at this point, so they don't have to answer question 8. I'm just going to go quickly through their apparently month of booking date is, or whatever this is. Percentage of API bookings is going up. They probably have a bit of a comparison. Yep, they have a comparison of the last 4 quarters. Trips. First quarter financial year 25 trips were down. Net revenue about $8 to $9. Anyway. Capital preservation. Actually talk about capital preservation. Continue to take a capital preservation approach to its cash flows. That has a 2 thumbs up. This resulted in the company increasing its payment terms with transport companies, resulting in a material net current asset deficit of 5.1 versus 3.8, despite net cash flow improving to 199,000 versus 238,000. Okay. The next paragraph sounds or seems a little bit negative. Oh, Jayride is looking to shortly open an entitlement offer to shareholders. That's a capital raising. Jayride is in advanced negotiations towards securing commitments from new investors to the company to both underwrite part of the entitlement offer and to provide immediate financing facility to the company on final terms to be discussed. So looks like they will be doing a capital raising in the near future. Okay, so next thing is the chart. And my first questions will, whatever, this is the daily chart. My first thought would be why? Why would you be owning this company right now? Share price is 0.3 cents. Sure, they're operating cash flow positive. I'd like to see any sort of growth in receipts or revenue, probably nothing much along those lines. And the chart looks pretty bad. I'd be, the share price low, by the way, is actually this. For some reason, I thought this went all the way back to now. No, the share price low is right now. In fact, look at the chart. This is an ugly chart. Share price just keeps on dropping. We have seen some big volume coming in during 2024, much bigger than what we saw previous few years. That could be just because the share price is so low. And so if you want to buy 2,000 shares, you buy way more shares. You just buy way more shares than what you were doing in 2023. That could be just a byproduct, an increase in volume because the share price dropping. But it's below 1 cent. I have no interest in this at all. Now, the question was, is this company going bankrupt? No signs at all about that just yet. Now, the good thing is they are not burning through cash. The other good thing is they have no debt. And if they're not burning through cash, they have no debt. There's no reason why this company will go bankrupt. Debt is the main reason companies go bankrupt. This company has no debt right now. That might change in the future, but right now, no debt. Okay, so hopefully I've answered your question, and hopefully it's to your satisfaction. Unless you want this company to go bankrupt, then maybe I have not. I have just discovered that I can scroll through these screens by just using the scroll feature on my mouse. There you go. That's awesome. And I just discovered that right now. That's amazing. Anyway, wait there. Just going to make sure. I had two slides on this particular question. So I thought I had 20 questions. It might be one question less than that. Okay, so let's go to the next question or comment. More of a comment than question. Maybe I am prolonging the torture here by actually talking about this. Please stop the torture, says Pro Jimbo. I had Pro Medicus when it was 17 cents and sold at $2.80, would be worth $45 million now. $45 million now. That's a nice profit. That's a 20 bagger. Well, not quite a 20 bagger. We'll say 15 bagger or so. Is it a 15 bagger? $1.70, 85, 265. We'll say about 15, 16 bagger. That's not bad. But the question is why? Why did you sell? Did you think it was overvalued, Pro Jimbo? I don't really want to prolong the torture. But let's go back and have a look. Not go back. Let's have a look at Pro Medicus chart. You bought at 17 cents. How long did you hold it for before it took off? So that's a question I'll probably ask you. You might have held it for like 10 years before share price started to increase and sold at 280. So let's have a look at chart for Pro Medicus. And what I'm doing now is I'm going back in time. Not that far back when compared to the age of the universe, but going back 10, 12 years ago seems a fair while. But in terms of the age of the universe, that's not. It's not at all. Anyway, so I'm going back to when the share price of Pro Medicus broke out. This was first of all, I'm going to mention, and I want to do a video on this. In my opinion, Pro Medicus's acquisition of Visage, I might have been named something different back then, in 2009, I think it was early 2009, I could be mistaken there, was or is the greatest acquisition in ASX history. Now, it took a bit of time before that acquisition bore fruit for Pro Medicus because they acquired it in 2009 and the share price of Pro Medicus broke out in 2013 or close to 2014. So it took about 5 years before we saw the signs of some success with his acquisition. But the share price of Pro Medicus broke out back then. Now, just looking at this chart, it was actually quite illiquid, Pro Medicus. Maybe not massively illiquid, but this is a chart of a liquid company. And the share price sort of moved into an uptrend in the middle of 2012. But I would have said a better sign would have been late 2013 at a price of about 50 to 60 cents. We'll say 60 cents. That is a breakout. Now, the low in middle of 2011 was around about 16 cents. So there is a chance that Pro Jimbo bought near the low. So there are people who believe you can't time perfectly the market. You can't buy at the lows or the highs. I sort of agree with that. But sometimes, or someone out there has timed it to perfection. So there's a chance that Pro Jimbo timed this to perfection, that the low was in 2011. But you can see in 2009, the share price was much higher. And the share price just continuing to a downtrend a few years after they bought that made that the greatest acquisition in the ASX history. Now, the reason I say that was a breakout for Medicus, share price started to move in uptrend in 2012, and the share price has remained in uptrend ever since. And the reason I say that, if you have a look at the daily chart, you would see a few crossovers. You'll see the share price does go below the 200-day moving average on occasion, fairly rarely. But if you look at the weekly chart, the share price has remained, in fact, the breakout was in 2012. Just like in the weekly chart. It's remained in a weekly uptrend ever since then. Now, if we go back to the daily chart and just have a look when the share price got to 280. So let's go back a little bit further than now. So what we're looking at is $2.80. Okay, so broke out in 2013 at about 60 cents, and the share price got to about $2.80 in 2015. So we're talking about a 2-year period where you did pretty well with this company. Oh, what did you say you sold it at? Yeah, 280. Oh, you bought it 17 cents. That's right. You bought it 17 cents. Breakout was about 60 cents, and you sold it 280. I would say, and I sort of can understand why people might do this, because if you bought it 17 cents, the share price has gone from 17 cents to 280, you have a lot of profit. And I think the natural feeling or want is to lock in that profit. I think that's so natural, particularly if your portfolio is heavily weighted to that one position, Medicus. Because if something goes wrong with Medicus at that point in time, then your portfolio could take a massive hit, and you'd be feeling absolutely terrible if you didn't do that. What I would do, and this is really hard, is just have a look at the chart. And if I was just having a look at the daily chart, there's instances when the share price wasn't doing much. So between like November 2015 and March 2016, share price really didn't do much, then moved into an uptrend. Share price sort of flailed in a period between 2016 and 17. In fact, share price reached a high in August 2016 and didn't get back up to those levels for another 2 years. And that sometimes happens. Sometimes it takes a share price of a company, even though it's in an uptrend, long-term uptrend, it can go sideways for a long period of time. And the share price of this company did nothing for, about 2 years, or actually about 18 months. And there's no real significant selling signal. No, maybe here. Maybe back in late 2019, 2020, I reckon the chart does look really bad here. Share price dropped from $38 back to $14. But when the share price was getting to $14 back during the COVID-19 financial panic, this company was looking quite attractive. I do know quite a few people who bought on that COVID-19 pullback. I did not. This was one of the companies that I was thinking about buying. Share price did a V-shaped recovery, and the share price will move back into an uptrend later in 2020. The share price also showed a little bit of weakness during the interest rates hike cycle. Share price pulled back to $38, and I bought just after that when the share price started to recover. Bought at $55, and I thought it was overvalued. And since then, there's been no reason. I've been given no reason to sell my position just yet, even though I think this company is just so overvalued, possibly overvalued. I'm going to say right now. Okay, so that's Medicus. I can't fault anyone who buys something at 17 cents and then sells at 280, even if the share price just keeps on going up. But if you do use technical analysis, maybe just use a chart a little bit more for your selling decisions, and it will keep you out of situations like this. So maybe that's the solution moving forward. Okay, this question is from Paul on Mayo. Now, I wonder if that's mayonnaise or possibly Mayo Clinic, which is one of the most recognized, one of the most wouldn't say, maybe not famous, but health clinics in the United States, founded by Mayo brothers. There was a joke on the Mayo Clinic in the movie called Flying High, which is called Airplane in the United States, when he's speaking to the Mayo Clinic or someone from the Mayo Clinic about a heart transplant, and in the background there's just mayonnaise jars everywhere. And if you've never seen that movie and you like a good joke, I think that sort of humor doesn't suit everyone, but a pretty good movie for a good laugh. Anyway, so Paul on Mayo, maybe Paul just loves mayonnaise. EZL, which I believe is Euroz Hartley's, announced 500% net profit increase on previous period, but price hasn't moved. Interesting thing about this company, this was not on my radar at all until some expert mentioned Euroz Hartley on a podcast, and the reason why they're interested in the company, because it seems like, well, I forget exactly why, but based off their assets and the income generation or something like that, this company looks really good value. So let's have a look at Euroz Hartley's. I think they're a broker or something like that, but I don't know. I got that from that podcast. And just because I'm trying to remember it, our memories can play tricks on us. But let's have a look at Euroz Hartley. Okay, first thing here is where the share price is. It's $1. $1 is an important level for all companies. It's a round number. And for some reason, investors, traders, are fixated with round numbers, particularly round numbers that start with 1. 1 cent, 10 cent, $1, $10, $100, $1,000, $10,000, $100,000. So $1 could be a little bit of a resistance or support level for Euroz Hartley. Announced a trading update on the 29th of January 2025. I have a feeling I missed this one, and also did interim dividend. I don't remember reading this one. So let's have a look for the first time. Improved 6 months trading. By the way, they should have an about section at the bottom, and they do not. I really like when companies have an about section, but I'm pretty sure they're in the broking, that sort of area. Oh, by the way, they do mention what they do in the second paragraph. West Australia, see, I did know that. They are in West Australia. Yeah, I did know that. West Australia's leading private wealth, institutional and corporate finance business. So there is potential that they might expand into other states. That is one thing I do notice many West Australian companies are trying to do, expansion into the eastern states. Anyway, so improved 6 months trading and overall solid profitability, total revenue of over $50 million. It's not a lot, but, an audited net profit of $6.25 million. So last year it was $1 million. So up 501%. This is what we're getting at. Now, there could be one-offs from last year. So that $1 million might have been significantly lower than it should have been, or the underlying profit. But if that is a real gain, that's an impressive gain, but it's on a low base. So remember I was talking about Monday.com, if you watch that little portion. So Monday.com has a P ratio of like 600, but I mentioned because if the profit is really low, then a company can expand that profit or grow that profit 500%, 1,000%, fivefold, tenfold in 1 year. So this is on a low base. $1 million from $6 million does sound impressive, but there could be reasons behind that. Also a dividend of 2 cents. So this company should have a pretty nice dividend yield. That's an interim dividend. So if the company keeps on growing and improving, the final dividend could be 4 cents. So that could lead to a pretty impressive or nice dividend yield. They are brokering because they're talking about brokerage revenue up 8%. Okay, I'm just going to have a quick look at this company's profit last year because they don't really expand on that. So what I'm going to do right now is just go back to, we'll go 2 years, have a look at 2008. We can have a look at the 2008 numbers. Ooh, unaudited profit and dividend. Yeah, okay. Let's have a look at these two announcements. So exciting, not knowing anything about a company and just going through all this. Okay. So last year they had a profit of 9.3 million. So I think if you look at the half-year profits, you're going to see a massive increase in profit from the first half to the second half of last year. And they also had a dividend of 3.5 cents, interim dividend of 2.5 cents. So the interim dividend actually dropped from last year to this year. So last year had a dividend or total dividend of 6 cents. So nice dividend yield, as I thought. And so we already know that the company's profit was about $9 million for the full year. There it is, $9 million for the full year. 2022, this company had a profit of $40 million. So the profit loss, or not profit loss, but profit decrease was 77%. I would say that this company has seen some one-offs. The other thing is, or maybe they sold some things off because revenue dropped a fair bit as well. So I'd have to delve a little bit more into this company. They also had a special dividend of 20 cents, which probably lends a bit of support to they sold something, and that's why revenue is down, profits down, and that's why they had a special dividend of 20 cents. They probably sold something. Anyway, so why do they explain why they had a special dividend? They probably don't explain it here. But what you can do is just have a look at their full year results or the financial statements. Here we go. So I'm looking for any sort of one-offs. So yeah, in 2022, they had a share of profits of equity accounted investments net of tax of 15.8 million, and last year they had nothing. And that's the big difference. That seems like a really big difference, but there's no big difference in the numbers otherwise. Although in saying that, their revenue went down a lot, but their expenses didn't go down a lot. So that's a little bit concerning, that the revenue went down a lot, but their expenses didn't decrease. And that's why the profit, apart from that share of profits of equity accounted investments in tax, was significantly lower. Well, what I'm going to do now is go back to the half year last year. So this could give us a bit of an indication of any one-offs and why the profit might increase this particular year. So let's have a look at the half yearly reporting counts. By the way, the company should release their half year numbers in the next few weeks, so we can get a better idea. And here we go. Yeah, so their profit, I'm in the wrong year here. I've gone back 2 years. I've gone back a little bit too far. In fact, I was looking at the 2023, so I went way back too far. I went back 2 years ago. Let's have a look at last year's numbers. So I went back and had a look at 2 years ago. So let's have a look at last year's numbers. So this could give a better indication. So revenue down again and profit down. So revenue down 7% and profit down from $9 million to $5.5 million. So that is actually a little bit of a concern. And I'm going to have a look at the financial statements again. If I can find it here, you have to scroll down all the way down. There it is. And yeah, revenue dropping is a concern. You know, I like revenue increasing. There could be reasons behind that. And then profit dropped as well. And there looks like no one-offs. There was a liability write-off, positive write-off in this particular half year or full year. Is it a half year? Yeah, so let's go back. And what I'm going to do is I'm going to go back to the half year results, which was in February of 2024, not 2023, just to have a look at their numbers. The reason I knew the previous one was wrong because it said profit of $3 million, but we know the profit was $1 million. There it is. So revenue down, profit down a fair bit. And let's just go have a look at the whole reason I'm doing this is just to see if there's any one-offs. Doesn't look like there is. So I'd say that's a real profit. And looks like there is potential. This company has turned things around. Now, revenue has been dropping, This trading update sounds positive because revenue, $50 million. By the way, was that revenue higher? They didn't mention if it has increased. So $50 million of revenue in the half year. If we go back again to last half year, they had revenue of $39 million. So revenue is up a fair bit. Profit is up a fair bit. So it looks like this is a bit of a turnaround story. Possibly. So the last few years has looked pretty ugly for Euroz Hartley. So let's have a look at the chart. Do we see a turnaround in the chart compared to or coinciding with what we're seeing with the financials? And yes, we do. Oh, amazing. Amazing. Okay, so if you have a look at the daily chart for Euroz Hartley's, this has been a massive downtrend. So from about the middle of 2022 to just recently, share price has dropped from over $2 all the way down to about 80 to 90 cents. So we have seen a significant drop off in the share price. In fact, the share price back then started to really go down in late 2022. Looks like there's been a couple of really negative announcements that really forced the share price in the second half of that year, and the share price kept on going down. And recently, we have seen the share price take off. So even though the company, what date was that announcement? 29th of January. So they released that. Funny enough, did they release that after trading finished? Yes. So this company released that particular announcement, that trading update at 4:11 p.m. That's probably why I missed it, because it was released at 4:11 p.m. And sometimes I do miss announcements released after the closing of trading. So it's more important what happened on the next day. And the share price actually rallied on the next day 7.6%. So this question, price hasn't moved. It's a little bit wrong. The price actually has moved because the share price before this announcement was actually 92 cents. Now it's $1. So share price has actually increased about 10%. And the chart looks pretty good. Chart looks pretty good. The only thing is I probably prefer a little bit more volume coming through. But we do see a subtle increase in volume. I really like this chart. I'm going to say it. And I really like this trading update. I thought maybe there was a one-off explaining that profit increase. And this chart looks really good. This could be a turnaround story. I'm putting this into my watch lists. Euroz Hartley's group. And I have to say thank you to Paul on Mayo for raising this, because this is the second time I've heard about this company. The first time I sort of ignored it. Now this is the second time, and thank you. And this sort of is true. It's saying that, or not the saying, but there is some truth to the thought that you have to read something or hear about something numerous times for it to take hold in your mind, your brain. And that's true with Euroz Hartley's. Next question from Simon Darmon 2230 is a long one. A comment you made about East Coast research recommendations. Can you please explain why you don't care about those type of things? I get their recommendations also, and notice that without fail, the share price rise after the recommendation. I've never acted on it and thought perhaps I should have. Are they a scam? Would love to hear your thoughts. I would not call them a scam. That's going a little bit too far. I am a proponent of empowering yourself or of making your own decisions. And when you put the decisions in other people's hands, I think that is personally not the best way to make decisions. You could do that, and then when it goes against you, that trade or that investment, you have someone to blame. And I hate that. I really, really hate when people blame other people when something doesn't go their way. Everything is in your control. All your decisions should be at your control, under your control. And when people just look at a research paper or something like East Coast Research, don't know anything about East Coast Research, or like Motley Fool, they have recommendation services, or what's the other one? Next Investors. They're putting their investment world into the hands of someone else, and I'm not a fan of that. So that's the very reason I don't look at any of these recommendation sites. And the other thing I noticed, you've mentioned here the share price sometimes will rally. Yes, I've seen that a lot. And a really good example of this is, I remember a company called what's it called? It's no longer on the Damstra. It was called Damstra. That's right. It's no longer on the ASX, but it's been bought out. The share price of this company rallied something like 10 or 15% in one day. No news flow or anything. And then I discovered that the company was recommended by one of the Motley Fool services. I don't know which one. They have like 5 or 6. And that's why the share price rallied. And I had then discovered that this happened a lot. Whenever Motley Fool recommended a company, share price would rally. And the reason I remember this one is the share price rallied to its all-time high. I think it rallied to like $2, $3, something like that. The share price then subsequently fell from $2 to $3 all the way down to 10 cents at the low within the next 2 years. And I'll always remember that. And I can almost guarantee you there'll be a lot of people who bought on that recommendation, bought Damstra shares, who blame Motley Fool for the movement in the share price. And they have no one to blame except themselves. And I think that's very important. I think owning your decisions is really important in life and also in investing. So that's one of the reasons why I don't look at any of these recommendation sites or these broker sites. The other thing is, and I know this is true for Next Investors, It might be true for East Coast Research. They get paid for recommendations. They get paid directly from the company to recommend the company to their clientele. And I do have a problem with that. So these companies, some of these companies might be more marketing companies than research companies. So anyway, so that's why I just don't care. I am of the belief that all decisions I make is up to myself. I will notice. No, I will say East Coast Research recommendations. I will say, oh, okay, that's interesting, but I will not make a decision based off that recommendation. I want to make a decision based off my own judgment. So if you said to me, I think this company is great, I'd say, well, it might be great for you, but for me, don't know. I don't understand why people get tips in the bars or tips by the taxi drivers and then buy a company based off that tip. I think that is one of the stupidest things in history. Empower yourself to make your own decisions, to research companies, find what works for you, what sort of investing strategy works for you. And I think you become a much better investor if you do that, or even trader. Anyway, so hopefully I have answered your thoughts. Simon Darman. Now on to the next question, which is from Medical Investor. Are you still holding Spark? No, but I'm keeping a close eye on the chart, because I think there might be some value when it comes to Spark, because the share price has pulled back a fair bit. Do you think their half-year results on Friday, the 21st of February, will be positive or negative? No idea. And this is a case where I just have no idea. In fact, I'd say most of the cases I have no idea when a company releases their results. And that's why I just look at the market reaction and go, oh, that's an interesting reaction. I think if the results surprise, you will see share price pop up. Because I'm starting to see a bit of a basing pattern form when it comes to Spark. In fact, let's have a look at the chart now. So this is the chart for Spark New Zealand, also listed on the New Zealand Stock Exchange, but this is the ASX chart. Share price hasn't been a downtrend for a while, almost 2 years. In fact, I'd say I'm going to get rid of the 20-week or 20-period moving average, just to make it simple. I do prefer just looking at 2 moving averages. Sometimes I will look at many new moving averages, but it becomes a little bit too busy. So I do prefer just 2. So share price of Spark New Zealand moved into a downtrend in March 2024. So we're almost talking about, well, that's 1 year, not 2 years. I'm getting a little bit ahead of myself. 1 year ago, share price at that point was 480. Share price now is 260. So share price has pulled back a lot. Has the market overreacted? I think there is definitely an argument the market has overreacted. Now, when the company did release their results in August, I believe that would be share price dropping on results on the 23rd of August. Share price dropped 7.4%. That was a negative result because share price has continued to fall. Now, we are seeing signs of a basing pattern forming. I think share price is now going sideways, consolidating. No sign share price is going to move up from here or down. It could go either way. If the share price fell below 250, that would be negative, but there might be some value in this company at that point. I'd be looking for a breakout or the share price getting above 280 on any sort of results, and that would be a really solid move for Spark New Zealand. The other thing I did with this company was have a look at their weekly chart, because this company had the hallmarks of a high-quality company up until recently. So if you have, or maybe not, this is more of a long-term cyclical company based off this 20-year chart. So between 2005 and 2013, share price in a long-term downtrend. And then between 2013 and 2024, in a really good uptrend. And now it's moving into a downtrend. So I get a different perspective by looking at this 20-year chart than looking at the 10-year chart. So when I said this might be a high-quality company based off their characteristics or the chart characteristics, that was just a 10-year chart. 20-year chart, I get a different vibe. I get this is a cyclical company. And now is not the time about thinking about buying shares. The low in 2011 was $1.60, and then it moved into an uptrend just after that. And by the way, that low in 2012, it must have been on negative news. Share price in that week fell 21%, and that was the low. So a lot of times when you see the low, so a company releases something negative, and the low over the next 2 months is that weak, that's usually a positive sign. And this is proof. I've noticed this time and time again. When the low is reached on that day or that week, that's a good sign. The market believes the worst has now been priced in and there might be positive things moving forward for a company. And that is true for Spark New Zealand in 2011. because then the share price moved into an uptrend and continued for a long time, over 10 years, and now it's complete opposite. 260, there's no idea if the share price might go down or up from here. Now, a good sign is the increase in volume. August, September, October, really big volume coming in, which is for me a sign that fund managers are getting interested in this county. But there's been, because the share price has not been rising during that time, and not a lot of volatility either. I think it's just been shares, moving from one fund manager to the next. And what you want to see is fund managers not selling, but fund managers buying. So more fund managers wanting to get on the registry, and that's when the share price could take off. But I have no idea what the results are going to be. Could be positive, could be negative. I'll just wait to see the results, because based off the daily chart, no reason to get in just yet for Spark New Zealand. One of the reasons I did take a position in this company, and I sold out pretty quickly because I was thinking, I just thought there was value. I thought there was value, and I went, no, it's not. I'm going to get rid of these. It's not a great reason to take a position just because you think there might be value. Unless it's a really high quality company. I'm not sure about Spark New Zealand. So I'm going through all your questions, and I just noticed I have another duplicate. That's the word, duplicate from Paul on Mayo. So instead of 20 questions, there might be only 18. Landy Lee, I just noticed for the first time today that there's a little symbol next to your name that says how long you have, not for everyone, how long you've been a subscriber. So Landy Lee has been a subscriber to my channel for 3 years. So congratulations, Landy Lee 52, subscriber for 3 years. Would you consider Beacon Lighting to be high quality? Beacon Lighting, not lightning, lightning. By the way, some people spell lightning with an E. If you spell lightning, the stuff in the sky, in thunderstorms, if you spell that word with an E, you're spelling it wrong. You're spelling lightening, which is a completely different thing. That's the opposite of darkening, lightening. Lightning has no E's. Lightning. Some people put an E between the E and N. Anyway, would you consider Beacon Lighting to be high quality? I always want to say lightning. Anyway, do I consider this company, BLX, to be high quality? I've never owned this company. So let's have a look at Beacon Lighting. Now, I'm going to do something a little bit different. Usually I start off with the financials, fundamental. Well, that's my background. When I first started investing, it was fundamental based. I have turned more technical based over the past few years. And even though I've become more technical based, I still look at the fundamentals of a company. I still am intrigued by how a company is performing. So instead of looking at the fundamentals, I'm going to start with looking at the chart. And a chart can tell you a lot. Now, just by looking at this chart over the last, or since they listed, so this company listed just over 10 years ago, the first thing is, if you go from when they listed all the way through to 2020, the bottom of the COVID-19 financial panic, definitely not the hallmarks of a high quality company. A lot of volatility here. A lot of volatility. Share price dropped from $3.40 down to $1.40 between in 2022, 2023. Share price is back up to $3.40 as we speak. Well, not today because the market is closed, but the share price is back up to that level. Maybe a double top. Chart since that low in 2023 looks really good. So if you bought or have ever bought Beacon Lighting when the share price has been below the 200-week moving average, you probably have done fairly well. So that is the thing I'm looking for when I'm viewing the long-term chart. I probably would like at least 20 years of history. 10 years, yeah, you can get a bit of volatility in there. Okay, so let's have a look at the daily chart for Beacon Lighting. This probably looks pretty good. Yep. Share price in a nice uptrend, 340, that is the all-time high. So it's at that important level. And I see nothing wrong with this particular chart. Typically, when I look at the daily chart, I prefer to look at the 25 and 100-day moving average. And I'm going to do that right now. There it is. And nothing wrong with this chart. I do like this chart for Beacon Lighting. So based off the chart, would I describe this company as high quality? I wouldn't be there just yet. Okay, some of the things I look for when it comes to fundamentals. I don't know why we have this investor conference down there. Close that crap out. So some of the things I look for, revenue growth. So I will look at revenue growth first, preferably revenue per share growth. Look at margins, return on equity, return on invested capital, call those the quality metrics. Some people might refer to those as efficiency metrics. And then, so I could also look at earnings per share, also dividend growth. And then I look at valuation, which is not quality thing to look at. You don't look at the valuation of a company, and that's how you decide whether a company is high quality or not. Anyway, so let's have a look at some of these things for Beacon Lighting. So revenue growth, we have 3 and 5 year and 10-year history for this company. I'm assuming not much capital raising, so shares on issue haven't increased that much. You could find this out just by looking at financials. I'm going to assume, and this could be a bad assumption, the shares on issue haven't increased all that much. So that revenue growth is fairly similar than revenue per share growth, if not identical. Now, first thing that pops out here is revenue growth has been slowing. 7.7% over the last 10 years, 5.6% over the last 5 years, 3.9% over the last 3 years. I do prefer that to be higher. If you think about revenue growth over the last 3 years, well, no, we'll go 5 years. No, 3 years. Whichever one, and then compare that to inflation, you don't see much growth there. Earnings per share growth is actually negative over the last 3 years, 12.6% positive over the last 5 years. So the 5-year numbers are okay, but nothing too great. And dividend per share growth negative the last 3 years, 11.7% growth over the last 5 years. That's pretty good, particularly if you want some good returns. By the way, if you just have a look at the returns of this company over the last, since they listed, 15.1% per year. That's actually not a bad return. I would take that, but don't forget, share price is an all-time high now. If you actually, what you can do is just go back 1 year. If you bought 1 year ago, or if you have a look at the total returns, 1 year ago, we're talking about 12.2% per year. That's okay as well. I don't mind. I would be happy with that sort of return on any company since they listed. Yeah. Would you be happy with, say, 15.1% per year? I'd be happy with that. Yeah. So share price has been increasing. And on top of that, you get a nice little dividend, which is 2.9%. It's not great, but if it keeps on increasing, your dividend yield on your initial capital would be eventually pretty good. Return equity, 28.1%. Return invested capital, 15%. Return on capital employed, 24.5%. These are 5-year averages. Those look really good. I do like those metrics. And gross margin is 69%. I'd like to see if gross margins are increasing. We don't have a 5-year average here. So a lot of times when I am researching a company, I just look at total revenue first. It's increasing through time. You can have a look at shares on issue in this, and let's do that right now. Shares on issue have gone up slightly, but nothing too much. I won't look at net income, but gross margins is something else I look at. So over the last 10 years, gross margins have actually risen. That's a nice little surprise for Beacon Lighting. So we have increasing revenue, increasing gross margins. There are good signs that this company is a high-quality company. The only thing I don't like is that revenue growth, but nice total returns, nice return on equity, return on invested capital, gross margins have expanded, revenue growing. It's one of those companies that if someone said to me, I think this company is high quality, I could put a counter view forward, just as I think all counter views are important. Even if you're very bullish on your view, I think having a different opinion is very important. So if someone said to me, I think Beacon Lighting is a high quality company, I wouldn't push back all that much, but I would say, hey, revenue growth has been slowing. Have you thought about that? That sort of thing. So to answer Landy Lee, I think I'm going to call it a quasi high quality company. How's that? A quasi high quality company. Another question for Medicus. This is from Motivational Flavio. Medicus had another big run and I missed it. Will it ever go down to a reasonable value? Now, that's a very fair comment. Or not comment, but putting reasonable in quotation marks, because what is your definition of reasonable? P ratio of 100? P ratio now is 250, so P ratio of 100 might be really reasonable. P ratio of 50? P ratio of 20? I think that's overly reasonable. That's way too reasonable. In fact, if Medicus went to a P ratio of 20 tomorrow, well, the market's completely collapsed. Share price would have dropped a lot. I would be backing my truck up. even though I don't have a truck. So I rent a truck, fill it with gold and silver and money, and back up my truck. And what do you back up your truck to? I don't know. That's a silly saying. Will it ever go down to a reasonable level? Okay, so this is the PE history for Pro Medicus over the past 10 years. Funny enough, they do have a total change in PE on FinChat with a CAGR, but that's sort of ridiculous. I suppose you could look at it and go, well, if PE ratio is actually down from 10 years ago, that's actually a good sign, but it's been growing. So if you have a look at this PE ratio history of Pro Medicus, the lowest it's ever been over the past 10 years is 55. Yep, 55. Back in 2017, during the COVID-19 financial panic, it got down to 70, and people were buying and getting very enthusiastic about Pro Medicus at that point. So that could be reasonable, P ratio of 70. 50, I would be very interested in adding significantly to my holdings in Pro Medicus if that happened. But I'd say back in 2017, Pro Medicus wasn't the talk of the town. More recently, P ratio of Pro Medicus got down as low as 96 in June 2022. And by the way, I bought Pro Medicus. When did I buy it? I don't think it was June. I bought in October 2022. So that wasn't a low. Share price started to rebound at that point. And in October 2022, the PE ratio when I bought was over 100. And I thought that was reasonable enough. However, I did think it was overvalued. And that's why I didn't take a massive position, because I thought, oh, I'll just buy an initial position, and if the share price drops a lot, I'll add to my position. That has not happened. It says here the PE ratio is 358. Is that right? Ridiculous. Anyway, I do know that's not a word, ridiculous. It's ridiculous, but it's okay. So that's sort of a reasonable value. It's really up to you. What's a reasonable value for Pro Medicus? Over the last 50 years, over the last 10 years, it's been 50. If you got down to 50, you'd be absolutely ecstatic with the growth potential for this company. Nick Patterson, 247, who has been a subscriber for 2 years, says or asks, actually, yes. Yeah, actually, there is a question here. Time to sell Praemium, PPS, question mark. Have a look at that. I'm trading that company right now. And I've noticed you've changed from 50 to 200 EMA across to 25 to 100. Can you please explain why? I actually haven't changed that. I might have used 50 to 200 once or twice just to test it. Maybe that's what's happened. But I usually use a 25 to 100. In TradingView, the screener, I have to use 20 to 100 because you don't have 25 as an option. So 50 to 200, I might have tested it a few times, but I do prefer 25 to 100 because it just suits my style of investing or trading. That's it. That's it. I would say if you want to give a trade more leeway, 50 to 200 cross could be, yeah, that could be your way. And I think that people do use the 200-a-day moving average a lot. So I can sort of understand why 50 to 200 cross would be oftenly used. But for me, it's just 25 to 100. So if you did see me using 50 to 200 once or twice, that's probably why I was just testing it. And sometimes I'll do that on the channel, just test it for a few days, and you'll see me testing it, even though I don't say it. Anyway, time to sell Praemium. Let's have a look at that now. By the way, this is the weekly chart for Praemium, ticker code PPS, going back 10 years. Is this a high-quality company? Based off this, no. I would not describe Praemium Limited as high quality, not only based off the chart, but also the company's financials. It has the potential maybe in the next 5 to 10 years to get to that point, but not yet, not now. So this is more of a trading position for me. So let's have a look at why I took a trading position in this company. It was on the back of some good financial numbers or like a trading update, that sort of thing. Share price was in a downtrend for a while. I'm going to get rid of the 200-day moving average. Was in a downtrend for a while in 2023. Hit a bottom late 2023, early 2024. The share price dropped a lot on the 22nd of November. There would have been an AGM. In fact, it dropped 35.34%. And I mentioned for one company, I forget which company it was, Spark New Zealand, back in 2011, I mentioned a lot of times when you see the share price of a company drop a lot, and it doesn't drop much from there, if at all, over the next month or two, whatever time period, that's a sign that maybe the bottom has been reached, that maybe the market is pricing or has already priced in all the negative news. And we see that with Praemium back in late 2023, 2024. Share price did not move any lower than the low that day. And yeah, that was a low. So that was at the 36 cents. And the share price moved into an uptrend recently. When I say recently, say August, September of last year, I think it's showed the first signs of breakout in July. I did take a position at that point, then I sold out really quickly, and then I bought back in. So that was sort of a stupid move. Bought back in on confirmation. I think this was a beautiful looking uptrend. Company recently had it released another positive trading update, and I think the reason why the share price popped up in August, results. So I'm just looking at when it popped up. 26th of August, share price popped up, results. They released a positive trading update not that long ago. 23rd of January, share price popped up 11.84% on that day. Share price did pull back on Friday to 82 cents. This is not a concern for me. This is not a sell at this point in time. This is not a sell at this point in time. I need a little bit more, well, I wouldn't say confirmation because I'm not even at that point, but with the share price above 80 cents, not even thoughts about selling, share price still above the 25-day moving average, 100-day moving average, and we have seen quite often in the past, share price of Praemium in this uptrend, which hasn't been going for very long, has pulled back to the 25-day moving average quite often. So we're talking about, by the way, the 25-day moving average is right on 80 cents. So I have no issues with Praemium right now. Typically, when I go through all the charts, all my trading charts, or all the charts I am trading, I usually write down the ones I'm concerned about, and Praemium is not on that list. Next question or thought, really a thought or comment, and I'll be honest with you, I love these sort of comments. It gives me something to look at, something to think about or dwell upon. So if you have any sort of a comment like this from StratVest, yeah, provide not only me, but all viewers with this particular comment or your thought or your technique, whatever you want, or strategy, whatever you want. With tech stocks, Kneppy, by the way, P's, not B's, I find the super strong ones, example, NVIDIA, back 2 years ago, are a great buy when they pull back at 50-day moving average. I can see that. Tesla does it a lot. And, I add at this point. So high quality companies pulling back to the 50-day moving average. Let's test that. Fairly quick test right now. What I'm going to do is just go through some of some companies on the Nasdaq or New York Stock Exchange. Maybe not PayPal. I'm not sure if I'd define PayPal as high quality. Amazon, high quality? Yeah, I'd say high quality. And so let's just have a look at the last 2 years. We'll go back 2 years ago. Why not? If you go back further than that, share price, I mean, if you use it, you do get a fair bit of crossovers, don't you? You'd be selling and buying quite often if you do use this strategy with high quality companies. You could use the pullback to 50-day, even if it crosses below 50 days, as a buying signal. Maybe that's what StratVest means. It doesn't mean sell when it falls below, but if it falls to the 50-day moving average, that's when you add to position. And with Amazon, over the last 2 years, you would have had 2 times that has happened. So yeah, it's happened twice. It's happened twice. Let's have a look at Alphabet or Google. And yeah, about 3 or 4, it does pull back to the 50-day moving average quite often over the last few days, last few weeks. What about Novo Nordisk? I would say this is high quality. Share price has turned pretty negative, or the chart looks pretty negative, but I think there's a lot of enthusiasm already placed in this company's share price. What about NVIDIA? So yeah, so over the last 2 years, the share price of NVIDIA even pulls back to the 50-day moving average quite a bit. 1, 2, 3, 4, and right now it's at that level. At that level, in fact, we've seen a crossover in the moving averages. I would not be jumping at that crossover. Adobe, no, we won't have a look at Adobe, but Apple, Oh, Apple, not much. Yeah, but the problem with Apple right now is I do think there is definitely an argument it's significantly overvalued compared to some of the other tech companies. Microsoft, sort of going sideways. Microsoft is now consolidating. And you can see a lot of moving average crossovers, which is a sign share price of a company is just going sideways. In fact, we saw about 1, 2, 3, 4, 5, 6, 8, 7 crossovers since July in Microsoft. Before then, yeah, 50-day was pretty good to add to your position. Shopify certainly has a potential to be a high quality company in the future. Taiwan semiconductor manufacturing company, I consider this to be high quality, and that is a good signal. 50-day moving average, pullback, buy. Tesla, I don't know, Tesla. Meta, yes, true with Meta. When it falls below 50 days, it doesn't fall much. In fact, I bought on a day the share price fell below 50-day moving average. They released results on the 25th of April. Share price pulled back 10.56%. I went, market overreacting, I'm going to buy. It was an instant thought. I saw it pull back, I went, I'm going to buy. Didn't have to think about it. And in fact, I bought almost at the low. Yeah, I bought almost at the low. There you go. And that was when the share price fell below 50-day moving average, rallied really quickly, and it's gone up since then by not quite 100%, but it's near enough. Anyway, so yeah, when the share price of a high quality company pulled back to the 50-day moving average, seems like a great buy. This has been true for the last 2 years. Last 2 years. Heinrich Burger 3839. I wonder if Heinrich Burger comes from Germany. Heinrich, I'm pretty sure, is like a German name, and Burger seems like a German name too. Burger without the E, without the U. Burger with an E. Anyway, Heinrich says, I recently sold out of Breville. By the way, I'm a Breville shareholder. I think Breville is a high-quality company. My only qualms about Breville right now is valuation. And I have quite a few qualms about valuations of a few of the companies I own in my high-quality portfolio. Breville is one of them. A bit too early as the price has gone up since selling. Their biggest mistake is America, or biggest market, not mistake. Biggest market is America. Most of their products are manufactured in China and some in Mexico. They have plans to relocate more to Mexico. I'm going to be interested to see how the market reacts to the tariffs. The market didn't seem to be factoring this risk. I still think the long term looks good. Breville is really interesting. Breville products are considered high quality throughout the world, which I didn't know, although sort of makes sense. I don't know. So I don't know. I've never considered Breville to be high quality, and then I did a research, and research shows that Breville products around the world are considered high quality, which is amazing. Let's have a look at Breville and their chart, and that's it. We'll have a look at the FinChat as well. Okay, so this is Breville's weekly chart, all the characteristics of a high quality company. This company listed, looks like in late 2008. What perfect timing. Share price back then was like $1, maybe even less than that. Share price in 2009 was 65 cents. Share price currently is $38.18. I'm going to do FinChat, just look at the return of this company since they listed, or even over the last 10, 15 years. This is a high quality chart, all the characteristics of a high quality company. The reason I say that is if you put the 200-week moving average, it doesn't drop below that all that often. It dropped below it a couple of times in 2015 during the COVID-19 financial panic, and then during the interest rate sell-off. It actually fell below the 200-week moving average for a fair bit of time, is now well above the 200-week moving average, which is another sign of it possibly being overvalued. Share price is near the all-time high as well. But this is the sort of chart you like to see. The other time share price was well above the 200-week moving average was just before the interest rate sell-off. And that's another reason why I'm a little bit nervous about Breville. The PE ratio of this company is probably like 40, maybe even more than that. If you have a look at the daily chart for Breville, I have no sell signal right now. We do on occasion see the share price pull back, but this is why I'm grappling with Breville, as I'm grappling with a few other companies, is the chart still looks really good, but overvaluation. I could lock in profits. And when I say lock in profits, I wouldn't sell completely. And I'm thinking of selling half and maintaining my other half in Breville and a few other companies. Or maybe not half, maybe my initial capital I'll take out, say $4,000 or $5,000, and just let my profits ride. I could do that and then deploy that capital elsewhere. I'm undecided right now. And the other thing is, if I do that and the share price pulls back significantly, I can then buy more Breville shares. Win-win situation if that happens. The share price could keep on going up, which would be the other scenario. Okay, Breville, is this a high quality company? I've always thought about this company as high quality, but let's look. I don't think I've ever done this with Breville. P ratio 46.9, that's probably high. But again, P ratio is not a sign on whether a company is high quality or not. It's just valuation. A high quality company can have a P ratio of 5 or 500. A low quality company can have a P ratio of 5 or 500. It's not a sign of high quality. I just look at that for valuation. So revenue growth. Consistently above 10%, particularly if you look at the last 10 years, 10.9% per year, beautiful growth. Last 3 years, only 8.8%, but that's okay. It's a shorter period. Earnings per share growth between about 8 and 10% over the last 10 years. That's fine. Dividend per share growth, a little bit lower than what you might expect. Only 2% growth in dividends over the last 10 years. So there is a possibility. What they're doing is putting most of their profit into growing the company for the future. And I have no problem with that at all. What else? Let's have a look at margins. Gross margin, 36.4%. I probably would like that to be a little bit higher, but this is a manufacturing company, so I wouldn't expect the margins to be that massive. Return on equity, 17%. Return on invested capital, 16.7%. So again, those are in the ranges I want it to be. More than, at least greater than 10%, preferably above 15%. So there's nothing here to suggest to me that this is not a high quality company. Chart looks good, nice metrics for a high quality company. By the way, if we have a look at the total return of this company, say over the last max, this company does the same thing as, no, it doesn't. So if you have a look at the last 20 years, it's not quite 20 years. It's 19.3% per year. Are you going to take that? Yes, you will take that every single day. But the share price isn't an all-time high. And if the share price does pull back a fair bit, that total return would be a little bit lower than that. If you have a look at the total return over the past, say, 10 years, well, so it's 10 years and 6 months. CAGR is at 18.2%. Will you take that? Yep, absolutely, yes. So nice return for Breville over a long period of time. And again, that's a sign of a high quality company. The other thing I mention or should mention is tariffs. I have no idea what's going to happen with tariffs. And one of the reasons I have no idea is because I think Trump has no idea. And I think sometimes he thinks of tariffs as a bargaining chip, as a threat to other countries to do what he wants them to do. So I don't know if Mexico will have any tariffs. He's saying fentanyl. The whole reason he's doing it is to stop fentanyl. Well, you can't say that with Canada because very little fentanyl is coming through Canada. If he is really trying to stop any sort of drug trade, we already know that the war on drug will never be one. I think there needs to be a different solution. But fentanyl is horrific, particularly when you get students, school-age children buying Xanax and it's traced or laced, not traced, laced with fentanyl, they die. This happened a lot. I'm surprised at how often this happens. It happens a lot. Fentanyl laced, one single thing, they're getting a safe product and it's laced. And that's the biggest problem. If someone intends to take fentanyl and they die, but when a 17-year-old takes a bit of Xanax because they want to sleep or whatever Xanax is used for, and it's laced with fentanyl, they die. It's happened a lot. There's quite a few YouTube videos on this, and that's how I discovered it. There was a YouTube video on this 17-year-old in California, a straight-A student, was either tired or couldn't get to sleep, or there was a bit of stress or something, and he just took one pill laced with fentanyl. He died. The person who provided him with that laced tablet was sent to prison for a long time, and he didn't know. But anyway, this sort of thing happens. I just don't know what's going to happen with tariffs. We just don't know. Okay, so let's move on to the next question from Zeus AI. I wonder if this is the real Zeus, one of the gods. I know you've gone over Mesoblast before. Could you please give me an updated opinion on the company after the latest announcements? I've been an accumulator of Mesoblast for 5 years and doing well. Would love to know if you have an estimate on the future of the company for 2025. That's hard. I am bullish. That's what I say. I'm bullish on the potential of Mesoblast over the next 5 years. They have a lot in the pipeline, and the most important thing is they were or did get FDA approval. That was the first big step for whatever it's called, whatever it's called. That's the first important step. So there is a chance I might get some more FDA clearance or approval during this year into 2026. And the chart looks pretty good at this point in time. So that's the most important thing, is there's no certainty when it comes to the future. Don't know, but definitely more bullish right now than I was just a few months ago when it comes to Mesoblast. So just keep on looking for positive news flow from the company, and let's have a look at the chart for Mesoblast. By the way, this is the weekly chart for Mesoblast. Is this a high quality company based off this? No, this is a trading stock. This is a trading stock. In fact, this is a horrific chart over a 10-year period. I think it even looks worse if you go back further. Yep, horrific chart, a lot of volatility in it, and this is a story stock. Has been a story stock all the way through this. Perhaps that story is coming to an end. Potentially, the story is like 500 pages, and we're on page 494. Who knows? Maybe. Anyway, the chart looks pretty good. Once we go down to the daily time frame, the company did release that FDA approval. That's why the share price popped up significantly on the, what day was it? The 19th of December. We have seen a bit of volatility since then. I am not selling at this point. In fact, the 25-day moving average has been a really nice support level for this company, going back even further, going back to October. You can see whenever the share price falls to the 25-day moving average, you buy. And it just bounced close to 25-day moving average. I would like to see the share price get above 340 because that was the highs back in, when was that? That was back in late December, early January. So it's a good looking chart. No reason to think about getting out of this trade just yet. When it comes to the rest of 2025, this company could release 3 or 4 really positive announcements. They could release 0. In fact, they could release a couple of negative announcements. We just don't know with this company. Kapow 4 says, would you sell Bioxyne entirely and take profits? Okay. Knowing me and these sort of setups or situations, I never completely take profits. What I usually do is I sell a portion, and I did not do that with Bioxyne, by the way. And then I will ride the other portion as long as possible, maybe not as long as possible, but if I get another sell signal, I'll sell. And then if I don't, that's fine. I did this with the Drone Shield. I've done this with a few companies, including Findy, EZZ, Step One. Drone Shield is probably my most famous case, even ZZ, yeah. And I'll show you those charts or those situations in a second. But first of all, let's have a look at Bioxyne and what I'm thinking about that company right now. So I originally bought Bioxyne back in August, actually September, and they did release a few really interesting announcements. Company's now cash flow positive, probably profitable, that sort of thing. And that's one of the reasons why the share price has moved up. We've started to see really good volume coming through, consistently good volume through February, end of January into February. Share price has popped up. The other day, share price dropped 17% in one day. Just before that, I was thinking of taking profits. So the 3 days before that day, I was thinking I should take some profits with Bioxyne because it was looking like fairly similar than a few other companies. But share price hasn't accelerated as quickly as some other examples. But I was willing to take profits those 3 days. When the share price dropped 17%, no, I'm not going to take profits just yet, even though the share price could fall a little bit more from here. Okay, so in the other 2 days, the last 2 days of the trading week, we didn't see any selling coming in. A little bit of selling, but not a lot of selling. And the share price has sort of stabilized at around 4.1, 4.0 cents. I'd love to see the share price just go sideways before the next move up. And maybe it needs to go sideways before the next good positive announcement from the company. So willing to sell a portion, maybe half of my position in Bioxyne a few days ago, not there just now. So what I'll do is sell half and then just see what happens. Just take a little bit of profits. Now, I'll go back to Drone Shield. This was a case where, and what we do is we'll go back here. So this is a case of me just getting, not nervous, but I just had a look at this run up in Drone Shield share price. So we're going back to July last year. Share price on the, what day was this? So on the Friday, well, my face is in the way. There we go. On the Friday, 12th of July, share price rose 7.3%. The next day, on the Monday, the share price gapped up on open. That can be a bad sign. Not always, but can be a bad sign. And the share price rose 11%. Now, the one-day candlestick doesn't look that bad. But I went, no, it's just accelerating too quick. Some good volume coming in, really big volume coming in those 2 days. And I thought, it's just getting a little bit too frothy. And I thought, I'll just sell. I think I sold 2/3 of my position in DroneShield on that day. And then what happened the next day took me by surprise. Share price opened higher. So it actually did gap up again the next day. And then we saw a massive sell-off. So on the next day, the Tuesday, share price sold off 22%. And I would say that was a really negative move. And I was looking to sell the remaining position of my company on that day. Then the share price fell a fair bit the next day, fell 22%. No, what there? No, 9% the next day. And I was waiting for a bounce. And then when I saw the share price bounce, I was going to get out. And I sold completely on the 19th of July. So I sold a lot on was it the Friday? No, the Monday. Was it the Friday I sold? No, the Monday I sold half. And then I didn't have to wait long. And the whole reason was because the volatility and just that really big down day was a bad sign for me. And the share price just kept on dropping. And does it continue to drop? Sort of, yeah. So share price has dropped from, I probably would have sold maybe 250, has dropped to 63 cents. So DroneShield, I did the same thing with EZZ, but I have not completely sold out of this one. So I saw the share price rallying just too much. It was just too much. And I sold on the 4th of October, I think, about 460. I know what price I sold, 460. And I sold before the share price went to a high of almost $5. And I thought, I shouldn't have sold. And then what happened just after that? Share price moved into a downtrend. And I've not completely sold out of this one. In fact, I'm going to maintain a longer-term hold in this one because I think there's value here. I think there's value in EZZ at these levels. Will not consider the same thing for DroneShield. And the main reason behind that is DroneShield is still, it's not profitable. There's potential. They could be generating a lot of cash flow, but it's not at that point. EZZ is profitable. They're growing, nice margins, that sort of thing. There's a few things not to like about EZZ. By this point in time, I do think there's possible value when it comes to this company. I'm very happy to take those profits, and I'm very happy to ride my position in this company because the money I have in EZZ is profits, not all the profits. In fact, a lot of profits I took out of EZZ, I've now deployed to other positions, but I'm willing to maintain that position because it's like a free ride, sort of. I think it's pretty dangerous saying that sometimes. Okay, something about Brookside. I have a feeling this might be the last one. I'm just going to have a look. Yes, this is the last one. I've replicated every single slide, by the way. This is the last question of the day from Brandon R661B or 18. Brookside, which I do own, and one of the reasons I own Brookside is I just think there could be value. Could be. I'm so conflicted by this one. Brookside released, I don't think the original message was written like that. Released their revenue by, increased. For some reason, the C's not there. Brookside increased their revenue by a lot on their last financial release. However, their operating costs also grew by a lot. I noticed that too. As a result, their free cash flow was lower than last quarter. Any idea what's going on with that? I noticed this, and I was a little bit peed off by this because I expected some really good growth in cash receipts and revenue, and they decided for some reason to, we're going to have this really good increase in cash. Let's, spend more money on capital expenditure. Let's do that. Let's do that. Geez. Anyway, so let's have a look at Brookside, and I suppose we can look at the chart, but the chart doesn't look that good. This was actually one of the Appendix 5Bs I was looking forward to the most because I did expect a pretty good increase in cash receipts, and there was a really good increase in cash receipts. So $21 million, and you can have a look at the year to date. So the previous 9 months, they had cash receipts of $24 million. So going from $24 million of receipts in 9 months to $21 million in 1 quarter, I was like, yes, exactly what I wanted to see. Cash flow positive, $12.2 million. The previous 9 months, they were cash flow positive by $9.4 million. And this is what I wanted. I was looking at this going, their share price is finally going to take off. They're finally realizing their potential. And I do expect some significant increases in revenue and receipts from this company over the next 5 years. I'm a little bit concerned now that what this company is going to do is to take that increase in receipts and revenue and just deploy it for future growth. And they can't keep doing that. They need to I suppose the best way to do it is they need to alleviate the negative thoughts many investors have of this company. And the best way to alleviate that is for dividends and for profitable growth. Anyway, so what we're going to see here is now in the cash flow from investing activities, they spent almost $19 million on exploration and evaluation. The previous 9 months, only $30 million. So they really expanded the exploration and evaluation. Now, they might have some explanation on this in their activities report. I have not gone through this yet. I was so pissed off with the expansion in capital expenditure. There could be a perfect explanation for it. For instance, they mentioned here partially offset the FMD plea related capital expenditure of $19 million. So there's a possibility that I am overreacting to this, that this is not as bad, that this could be, maybe the next quarter is going to look so much better when it comes to capital expenditure. But the reason it pisses me off is operating cash flow positive, 12.2 million, free cash flow negative, $6.8 million. I was like, oh, geez, really? So this company is spending a lot of money on exploration and evaluation, and they need to become more, what's the word, sustainable. At this point in time, they're not sustainable. They're spending a lot of money. It doesn't matter if this company is operating cash flow positive. If they're spending, $19 million a quarter on exploration and evaluation, this company is not sustainable. They cannot keep on doing this. So they need to get to the point where they are generating free cash flow. And maybe they will get to that point in maybe this year, next year. That's one of the reasons why the market is still skeptical on this company and why the share price just won't take off. And the other thing is cash on hand is decreasing. So it's fallen by $2.4 million. And one of the reasons I really like this company not that long ago is because they had so much cash on hand, and they're just starting to, deploy that cash on hand extremely. So I don't know. There could be some really, by the way, I've just noticed this. I didn't go through this, but I just found this right now. Capital expenditure, investment for exploration and evaluation for the quarter, net of payments from working interest, primarily associated with the successful conclusion of the company's 4-well FMD project, which was completed ahead of schedule. It says successful conclusion, which tells me this capital expenditure may be just not one-off, but it won't be so high the next quarter. So hopefully that is what we're going to see in the next quarter. Anyway, that is all I have for this particular answer and reply video. I thought this would be a way more efficient way of doing things, but it hasn't been. I do time each video, and even though I have not made any significant mistakes and had to, redo a section, this video in recording has gone 2 hours. Now, I'm not sure how long it's going to be as a video, because I do a fair bit of pausing when I go from this particular slide to your questions. No, not this particular slide, from your question slide to looking at charts and that sort of thing. There's always a pause. When I do this answer reply video, just looking at your comments online, there's no pauses at all. It's straight through. So it's going to be interesting to see how long this video goes. I was thinking like an hour, but with all the pauses, I'm thinking an hour and a half. Anyway, so a little bit longer than I thought. So potentially in the future, if I keep doing it this format, less questions, maybe 10 questions, which is a shame, because I think 20 questions is good. Answers were quite long. Anyway, so I'd love to hear your thoughts on this new format. So leave your thoughts in the comment section of this video. That's it. Have a good day. Don't forget, I'm not a financial advisor. If you need financial advice, make sure you seek out someone who's qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.